Hey, buddy, how's it going?
Good, Frank. How are you?
Good, good. So, the first question, the most important thing I want to discuss with you, and this is by far the most important topic before we get into everything because there's so much going on, right? Is did you make the playoffs in your fantasy football leagues? Are you in the playoffs right now or no?
I'm in the Super Bowl. My youngest son and I are in the Super Bowl of one league, but I didn't make the playoffs of the other three. So 25% batting average. It is what it is. It's a
Yeah.
strange year in fantasy. Oh my God. It was
Yeah.
just,
I mean, you had an opportunity to pick
it
up a
was a
lot of
really
great
strange year.
guys during the year, which, teams are so different. I mean, you have like, you're looking
Yeah.
at so many running backs out, right? I mean, the top two picks are out, and you got just, a lot of injuries, but Justin Jefferson's came out of nowhere. You're looking at so many
Yeah.
just players that are incredible that you could pick up. But yeah, teams are definitely
Yeah.
different now than they were in the beginning.
In my big league, after my draft results, I got an A+ rating from their artificial intelligence, and I missed the playoffs. I had guys like Ezekiel Elliott who underperformed, and Le'Veon Bell underperformed, and Lamar Jackson was my keeper from last year. He underperformed where he was supposed to be. So, it was a mess. It was a mess.
It's amazing too, right? Because you see like the algorithms, but it's amazing where this is the first year I've seen probably in the last 15 where you're looking at high frequency trading algorithms. A lot of them are down. I don't know if I guess being prepared for a black swan event isn't part of the computer system, and you can see how
Right,
random it
right,
is.
right.
Right? It's kind of crazy. You see the performance. I'm not ragging on them because these guys have been right all the other time, and I think a lot of that has to do with front running and getting in, early and just trades and not even knowing anything about the companies. But again, that's my personal opinion. But still, it's kind of amazing to see over the past couple of quarters of how a lot of these guys have underperformed. It's just surprising.
Yeah, it's been a strange year on a lot of levels.
Well, let's talk about a lot of things going on. And one of the topics you say is animal spirits appear to be back. You're talking about those major IPOs, the Snowflakes, DoorDashes, Airbnbs. I mentioned this, John, that we look at the IPO when they come out and how much they've gone up since the IPO. But I think if people don't realize, you look back 6 months and the valuation of these companies is like 2x or 3x in 6 months.
Yeah,
so,
that's crazy.
The valuation
Yep.
pre-IPO, right? I think even if you look at Snowflake, where Buffett came in at 120, I think it was probably valued at 75 or something 6 months ago.
Mhm.
And now it's 350, went to 400. What's going on here? Could this continue? Is this all about hype? I mean, you don't want to jump in front of a moving train here. It seems like these things you could buy after the news and still make money, which is a very scary scenario to me. It usually doesn't last long, right?
Yeah, I think, Frank, what you're seeing in the world is that there's an excess supply of cash, and you need a place to park it. This COVID, the COVID economic shutdown was very different, clearly, from 2008 and 2009, the great financial crisis, because, after we got out of the crisis and the Fed printed all this money and the government provided all this stimulus, you still had to delever the economy. The economy still had a lot of debt that it had to work out. The banks had to go into all this financial regulatory situation where that prevented them from issuing more capital, right, and making more loans. Now you're in an environment where literally we shut the light switch off. The government and the Federal Reserve provided all of this money to the market, whether it's through quantitative easing or the CARES Act, and now a second stimulus packages, is on deck here. So you had a massive amount of capital that's really been pushed into the economy. And now that we have the vaccine, starting to roll out, and we get, a wide acceptance by humanity, in theory, 6 to 8 months from now, we turn the switch back on and you have, a stronger economy. I mean, economists are projecting a 5% GDP growth rate year over year, which would be the fastest growth rate since 1984. You have interest rates at zero, so the cost to borrow money is nothing. You have, by and large, you have the U.S. housing market is really strong, and you have the most amount of money sitting in money market mutual funds in like history, and you have $18 trillion of global bonds that have a negative yield. The U.S. 10-year Treasury is yielding less than 1%. You're not earning any money on your cash. So what are you going to do with all of this money? When once we get through the COVID here, what are you going to do with all this cash? Corporate earnings have proven to be very strong, beating expectations. So you have this, massive amount of capital, risk appetite is back, and it's looking for a place to park, and it's going into, private equity. It's going into the stock market. It's going into IPOs. You've seen this new SPAC, special purpose acquisition companies. You've seen that come through. People are looking to get a greater return on their investment than zero. And so they're just pushing capital into whatever is going to work, or whatever wherever they feel that there's a greater propensity of return, and they're willing to take on more risk than where they were, say, 6 to 9 months ago. And even on the corporate side, I mean, look at companies are flush with cash. There's a reason why Johnson & Johnson took on 30-year debt paying 2.75%, or Amazon and Google, taking on 25 or 30-year paper for less than 3% to borrow from a coupon standpoint. I mean, they're earning that 3% in their sleep. That's free money. So you're going to see, and when you're a $2 trillion company, it's hard to grow organically. So what do? You're going to go out and buy your revenue. So you're seeing a massive amount of push into the mergers and acquisitions. You're seeing deal flow in every sector. It doesn't matter. You're seeing it in banks recently. You saw 2 regional banks merge a couple of weeks ago, or last week, I should say. You're seeing in the energy space, tech, healthcare, and we just think that's going to be a place that's going to continue in 2021 and beyond. So, definitely a more bullish stance for risk assets going to the new year, based on 2 things, right? There are 2 things that derail that. One is, if the Democrats win and the Georgia runoff, right, then that gives Biden a clearer path to increase corporate taxes, which is bad for stocks in the short run. And then obviously humanity's acceptance of the vaccine. If we get spooked and there are, side effects that come up and it prevents people and people wait, well, then, this whole socially distanced economy just continues.
Yeah, it's interesting. I guess my question to you is how much is that factored in, right? Because this is a market where, we have Interactive Corp on the books, right? And I'm familiar with the Vimeo platform, which they're spinning out, and I've used all the platforms, and I built my whole company around this platform that we're using right now. My thesis when I recommended August was that they were going to spin this out, right? They announced that, hey, we're officially spinning out, and the stock takes off 15%. We're seeing this a lot now, where it used to be buy the rumors, sell the news. It's buy the rumors and buy after the news, and you're still making money. So I guess my question is, how long can this continue, and how much is this baked in, considering we all know, right? What we do know is that interest rates going to stay low for a long time, right? There's no place else to really put your money to earn. I mean, you're better off even putting them in banks now, right? They just announced that they could increase, buybacks and dividends now. So you've seen that sector take off, and those stocks are relatively cheap to book value. But how long can this continue, where I feel like we've been talking about this for 3-4 months? We've seen the market surge to all-time highs. We're trading at what, 22 times forward earnings, around there, 23 times forward earnings. So I'm with you. I see money continue to pour into it, but is a lot of that factored in already? Or, you see 2021 as, hey, it's got to continue. There's no place else for the money to go.
Well, I think you have to unpack a couple of things. One is the stock market and then the bond market. So I do think that, and I think the returns on stocks and bonds are all a function of how the number of COVID cases come down, how the economy reopens because more people have become vaccinated, and how those people that have been wanting to spend money have sat on the sidelines just because they're in some sort of quarantine situation. They're not living the life that they were back in January and February. So it all depends on that. If we are able to get to, a bit more of a normalized lifestyle by the summertime, I think stocks can totally run higher. If it takes longer and it's a year from now, Frank, and we're still rolling back the economy or the car is stalling here where we're trying to get back to normalcy, well then, stocks are going to sell off because the market is clearly looking through the pandemic. The market is definitely looking through the virus. And if you believe in sort of the bull case here, which I'm putting forth, is COVID has been known as the great accelerator, right? I mean, e-commerce was, a trend that was growing. Now, because we're on lockdown, it has taken that, to a whole different level. Companies, we are all doing more with less. Every single company, every single person, every household, is having to adjust in some fashion. And on the corporate side, it's making profit margins. It's holding up profit margins well. So if you can grow the top line again, if you can grow your revenue and your company overall is leaner, your profit margins are going to grow, and that's going to push stock prices higher. And then bake in 2021 and 2022, where companies will start buying back more of their stock, something they haven't been doing, or at least cut back on, because they've been husbanding cash to deal with and have greater liquidity in this black swan event. So I do think that the stock market can go higher. I do think it's set up for a really good position. Conversely, I think longer dated bonds and the bond market is a big risk, because although the Federal Reserve, to your point, has said they're going to keep interest rates at zero through 2023 or 2024, that doesn't mean interest rates can't go up, right? Interest rates move on inflation expectations. And if the situation is what I'm putting forth to you, you have a strong housing market, potential 5% GDP growth rate, strong stock market, we end COVID or reduce the impact of COVID. Guess what? The economy is going to rip. It has the potential to rip. And the Fed is going to do what it did back in 2013 when then Chairman Bernanke said, well, we're going to cut back on our asset purchase, right? So you're going to have a potential taper tantrum 2.0, where the Fed went into COVID with going the interest rate zero. Then they said, we're going to buy muni bonds, and we're going to buy treasuries, and we're going to buy agencies, and we're going to buy corporate bonds. Now, if the economy rips and you're starting to see inflation come back, they'll just walk backward. They'll stop buying treasuries. They'll stop buying munis. They'll stop buying agencies. They'll stop buying treasuries, or they'll just lower the pace, which is an act of quantitative tightening without having to increase interest rates. And right now, the U.S. 30-year Treasury has like a 1.8% yield, which means if you bought the U.S. 30-year Treasury right now, you're locking in 1.8% return on an after-tax, after-inflation, on a pre-tax, pre-inflation basis for the next 30 years. And if you include taxes and inflation, you're basically locking in a negative rate of return. So again, then you get back into this, if you remember back in 2017-18, you get back into a TINA market. There is no alternative other than stocks or fill in the blank risky assets, private equity, SPAC, whatever it is. So I do think this has room to run.
Now, you always send me notes and we talk offline sometimes just, about different subjects we're going to talk about. It seems like we know the Fed wants to inflate the markets, right?
Yep.
And regardless of how much you're paying in your electricity bill or in tuition, and almost every one of your bills and food is up tremendously, it doesn't matter, right? Because what they look at is consumer price index, right? So, and that's, below 2%, maintains below 2%. But is inflation a risk for you, or quick, it happens really quick? It was a great segue because you mentioned that. But what worries me is you have... you mentioned the numbers before. I mean, globally, right? Trillions and trillions and trillions, right? It was 8.5, 9 trillion, whatever it is, right? Flooding the markets. This money is going directly, right? These are checks. They're bypassing the economy, right? They're not going through the economy. They go right to the consumer, right to businesses. This is in 2008 where you sent all this money to the banks to stabilize the system, right? And then they invested in the banks, and we all know what happened there. And the Fed made an incredible amount of money, right? Backstopping everything. But this is different, where we haven't seen inflation in a long time. I feel like still nobody's really talking about it. You see a couple of hedge fund managers worried. Could we get inflation a lot quicker than expected, to the point where the Fed maybe mid-year, right? Because if we surge, I think most of us are bullish, and I agree with everything that you said. What happens if we see this massive inflation where the Fed actually changes its tune and it says, okay, now that we have inflation, it goes to 2.5%, 3%, which may seem a lot right now, but it's really not historically. And they start backtracking, saying we might raise rates. I mean, is that something of a risk?
I mean, that is the ultimate risk in the bond market. The bond portion of, you're going to have, your viewers and your readers are most likely not all in stocks. They most likely have some allocation to bonds, whether it's in their 401k, the retirement account, something along those lines. Longer dated bond funds, as Warren Buffett once said, right now is return free risk. You're not getting anything for the inflation risk that you're taking on in your portfolio. So you really have to look at that portion of the portfolio, which I think there's a tremendous amount of risk. Now, inflation is good for stocks if it is somewhat controlled. I mean, if you go back, if we get into a hyperinflation of, a massive rise in inflation in like we saw in the 1970s, hyperinflation that we saw in the 1920s in Germany, that's going to be a problem. I don't think anyone's expecting that. I do think the crater in the economy left by COVID is still severe. I still think there are a lot of businesses and a lot of people that are suffering. I do think a lot of stimulus checks that go out to people, are going to go to help pay down some bills and pay their rent and are going to go from a needs standpoint. When COVID hit the economy, Frank, remember, we were at a 3.5% unemployment rate. By and large, the economy was healthy and people could absorb, and companies could absorb a punch to the gut. We're 9 months later. We haven't had a stimulus package or a bailout package from the government since May or June. So there are a lot of businesses and a lot of people who have run out of their liquidity. Maybe the businesses have shut down. Maybe people are starting to file for, the government's probably preventing filing for bankruptcy, but you're considering that. So I think this is this stimulus check that when it ever gets approved and sent, and hopefully it's sooner rather than later, will be helpful. And then, to provide some liquidity, some relief. And then, once we get through COVID, we turn the switch back on. And I do see, we should have a massive rise in employment again when people get hired, much like we saw in the summertime. Remember, the unemployment rate went from where were we, 18, 19%, something like that in April, March, and it came all the way down to, where are we now, 7%, a little bit under 8%, something like that. So, that's stalled. I would assume the economic data that comes out in January is going to be terrible. You know what I mean? I mean, it's not, with the amount of how the economies are starting to roll back, with the amount of hospitalizations, people are getting more nervous, governments are getting more nervous, that sort of thing. I would assume that, just like, that the data that comes out, the economy will underperform what happens in January. Again, we just hope that enough people get vaccinated in the next 3 or 4 months, and we could start turning the corner.
Yeah. I mean, I couldn't agree more too. It's just, in terms of COVID, in terms of the market.